The stock market dropped 92 points today as investors expressed concern over the lack of a deal in Washington to avoid a government default next week. 9 News reporter Tom McKee is here with word that's just one concern of local market analysts. Tom?
Well, Clyde, August 2nd is the deadline for a new deal to raise the debt ceiling, or the U.S. will run out of cash to pay its bills. Now, brokers here think that's unlikely, so they're advising clients to hold onto their portfolios until Congress decides what to do. However, that's not their only short-term concern. From his office at Fort Washington Investment Advisors downtown, Nick Sargent is reaching out to clients and advising them to hold their positions. However, even the remote possibility of a technical default is stuck in the back of his mind.
If politicians can't get their act together, I would expect then a major sell-off in both the stock and bond markets.
Keith Wertz of Fifth Third Asset Management says he thinks the damage from that would be catastrophic.
You'd see individuals and consumers witness their portfolios evaporate right before their eyes to an extent, so you'd have that risk.
A more likely scenario, though, would be the bond rating services Standard & Poor's and Moody's lowering U.S. Treasury debt from a AAA to a AA rating. That could hit banks hard.
The rating agencies have said if there were a downgrade of U.S. Treasuries, it might also cause them to downgrade the ratings of U.S. financial institutions.
But the biggest blow could hit consumers right in the wallet with an uptick in interest rates.
Consumers may see higher car loans, they may see higher mortgage rates. Those kinds of implications are likely to come out of this whole debate.
Realtors are looking at that with concern. Since home prices have stabilized, there's plenty of affordable inventory and interest rates are low.
Right now, the interest rates are very important as far as of continuing the momentum we have in the real estate industry.
Pete Koff, president of the Cincinnati Area Board of Realtors, says a rate hike could only point housing in one direction.
If they did go up, it would have a fairly negative impact on the real estate industry.
One interesting note, Keith Wertz called me after the market closed this afternoon and said that right now Procter & Gamble is a better investment than the U.S. Treasury debt based on the current yield, Clyde. A very interesting fact and maybe a message for Congress.
And certainly a sign of the times, Tom. Thanks.